Good afternoon and welcome to another edition, our first edition of the 2018 Graystone Brownback Sessions. I am Rafi, Chief Operating Officer of Graystone Investment Group.
I am Jorge Vasquez, CEO of Graystone Investment Group.
Happy New Year.
Happy New Year, man. It's been a while.
It's been a while.
I know.
I was sick. You were sick.
Uh-huh.
We got the new year.
A couple of vacations in the way.
Vacations on the way. Yeah. So we hope everyone had a great holiday season. And as always, we have the beautiful Stephanie in the background. Hi, Stephanie.
Hello, guys.
There you go. Stephanie didn't do the Facebook Live while we were out. We need to encourage her to maybe do it next time.
You gotta do it, Stephanie. You gotta do it.
Now, Jorge, where can they find us?
Rafi, they could always find us at homes4income.com. That is homes4income.com. Cannot be easier than that, guys.
Don't forget to subscribe to our YouTube channel. It will be in the description, and also Stephanie's adding the link to the comments so you can find them there. And today it's a very let me put this on mute. Yep. Today is a very important topic that you need to do. We recommend to do this every single January. You know, you turn the page on the calendar. It is very important that you evaluate your portfolio, you evaluate your real estate portfolio. Actually, your real estate, if you have mutual funds, stocks,
whatever the case may be. Yep.
Perfect time to sit down. You probably have the CPA calling you, starting to set up the tax process, all that kind of stuff. What we're going to talk about today is 4 tips to evaluate your real estate portfolio at the beginning of the year. So 4 things that you should be doing every single time at the beginning of the year to make sure that you're on track to meet your goals.
When it comes to your rental properties, right?
Exactly.
That's what we're talking about.
We're talking about your real estate portfolio today. And again, it's important that if you have your GPS with a destination, once in a while you need to check the GPS to make sure that you're on the right track. Sometimes, guess what? The GPS says, hey, big traffic ahead. Take exit, 28 instead of 34. So what we're trying to do is that here. We're trying to make sure that we look at that portfolio, we look at the GPS, and hey, are we still en route to hit the real estate
goals? It's kind of hard once you're in Jacksonville to go back to Miami,
I know.
That's what we're trying to do here.
Yep. And it's something that I'm sure you have done a lot, throughout your career as an investor, right?
Absolutely. It's something that you got to look at in a yearly basis. Mm-hmm. I'm a former financial advisor, so I've made it a habit, even with real estate, to check it in a yearly basis, because you never know. You think that your assets are doing well, but if you don't check on them, they could be going sideways. So.
Yeah, and again, it's very important that we talk about processes all the time. This has to be part of your processes, of your annual process. Yes, you're giving him all the documents that the CPA needs for the taxes, whatever. This has to be part of your process of things to do every year. And by the way, we're talking about something that you should do probably on a quarterly basis, but then on an annual basis, you really take a deeper dive into it and make sure that, again, you are on track to meet those goals. You cannot put an autopilot. Yes, we talk about passive income, and those of you that were in the seminar that we had, we are fans of passive income, but that doesn't mean that you're completely off the hook here.
Absolutely.
You have to have, again, we recommend the quarterly, but definitely at least once a year, you need to have this deep dive in terms of your portfolio. And the first tip in terms of, there you go. The first tip in terms of how, things to do to evaluate your portfolio is basically, how is the portfolio doing? What is the performance of your rental portfolios doing? And of course, we use one metric. There's several metrics, but the one metric that we like to use is
the cap rate.
The cap rate. So what do you like to do in terms of the cap rate as to evaluate the portfolio at the beginning of the year?
Well, Rafi, it's very exciting. It's your first year, right? You've rented the property. It's been 12 months, and you're like, man, did I do what I was supposed to do? Mm-hmm. Did I make the money that I was supposed to make? And when you first bought the property, ideally you look at the cap rate in order to understand more or less what you were going to get.
Right.
Whether the cap rate was 8%, 10%, 9%. The cap rate pretty much illustrates, Rafi, how much you're going to get in a percentage basis. So you take your income divided by your investment, and that's pretty much it.
And again, there's different stages in terms of cap rate. We have for those of you that this is the first year that you're doing this, guess what? That first year is not going to look good, right? Why?
That's a good point, Rafi. The first year is your tryouts. To me, it's the tryouts. There's going to be a lot of things that go wrong. By the way, I met with a bunch of guys that are smarter than me yesterday, and when they assessed commercial properties, what was that, Rafi?
No, smarter guys. I just pointed to me.
That's why I didn't say smarter than you, because nobody's smarter than you. I just said me. But seriously, when these guys are assessing $5 million projects, $10 million projects, $20 million projects, guess what? Their quote for the first year cap rate is way less than year 2, 3. So it goes in a scale.
But why?
Well, because at the beginning, you getting to know your property. You don't know the issues you're going to have with the property. You're getting to know your management. You're getting to know your tenants. There's a few bumps that you're going to have in year 2 that hopefully you won't have. On year 1, hopefully you won't have in year 2.
And when you think about it, it makes a lot of sense.
Makes sense, right?
The first year, you probably are making major repairs to bring the property up to par. Again, so first year you have high repairs. You may have closing costs, of the acquisition. So you have a bunch of things that you spend on the first year that on year 2 and above, and after that, most likely are going to start, lowering.
Sometimes you get lucky for most of the time. Like I said, the pros, even the pros, calculated lower year 1, higher year 2, and even higher year 3. So it's an average of a 3-year exit strategy, 5-year exit strategy, however you want to do it.
So in terms of evaluating the cap rate for that first year, you want to know if you're hitting that target, right? So if your target was 6, let's say, because because it was the first year,
6%.
So it's 6%. Did you hit 6%? And again, that's for year 1. You may have other properties in your portfolio that are on year 2, year 3, year 4. Okay, maybe the goal on those was 8%. But are you hitting 8%? Right. Was your vacancy too high? You really need to look at and analyze. And what we like to do is we like to rank them. So before, you just have all the properties in a spreadsheet, let's say. But now, guess what? Let's calculate the cap rate for last year. Okay, some of them will be year 1, some of them will be year 2, year 3. But let's rank them to see which property is giving me the most cap rate. Okay, and not only that, which property is giving you the most cap rate versus your goal. Because you may have a property that gives you 9%, but your goal was 10.
Right.
And then you have a property that your goal was 6, and it's giving you 7. Well, guess which one is performing better?
Right.
The one that gives you the 7. So not only rank them by the cap rate, but how they're performing against your goals, and then make some decisions, right?
Absolutely, especially when you have a portfolio of multiple properties. You need to know which ones are doing better, which ones are doing less better, and then decide. Maybe you want to sell one of them, perhaps.
Sell one. Maybe you want to increase the rent on some of them. You make an analysis. You know what? This one is not performing, but when you look at the rent, it's under market. We had that. We had several properties that we suddenly found out, wow, the market went up significantly. So let's see if we can get a bump. Or hey, maybe your property manager is not, you have high vacancy. So maybe it's a conversation with the property manager. Say, hey, what's up? Why we're getting high vacancy on my property? Bottom line, it's for you to make decisions based on that information.
Absolutely,
right?
Absolutely.
So again, that first tip is evaluate the performance of your portfolio, and then make decisions based on
vacancy, repairs. Sit down with your property manager. By the way, your property manager should know how to illustrate a cap rate. Should know how to help you set that up. If not, then I'll be a little concerned.
A little?
I'll be very concerned.
Very concerned. If a property manager doesn't know how to show you a cap rate, run. Man, I'm still sick.
Because you're there for the investment. You're not there to just rent houses. You need to know.
Absolutely. The second tip to help you evaluate your portfolio at the beginning of the year, we look at performance. But now, we're looking at value. Let's see how much is the value of your portfolio, okay? There's different tools to do it, but I know you have your favorite one is?
Guys, the one I like the most is called the CMA, which is the Comparable Market Analysis. Okay. The reason I like it is, this one main reason, Rafi, is that it compares the subject property with the comps at the curb appeal level. In other words, Because you could go to Zillow and Trulia, and it's going to tell you, it's going to match your property with other properties that are similar, but you can't compare apples to apples. You might have a property that has the same square footage, but this one looks foggy, and then this one has a different curb appeal. So what I like about the CMA is that it gives you all the numbers, but it allows you to put your house next to other potential comps and say, okay, well, yeah, they have the same numbers, but this is not the same. You know, let me take this one out. Let me take this one other out, and at the end have a way more accurate representation of what the value is. That's why I like CMA.
And this is something that you definitely, you know, as part of your real estate team, you want your realtor, you know, someone kind of third party in a way to do this number. It's not you going to Zillow and picking the number that you like the most. No. You want someone that tells you, hey, if I were going to sell this property today, I will sell it for this much, okay? And it is very important that you know the value. So now we have the performance. Now we want to know the value of your property because that impacts a lot of other decisions, right? You may have, for example, the first thing you did was looking at the performance cap rate. Now you may say, you know what, I have something that is low performing, and then when you do the CMAs, the equity has increased a lot. Guess what? Maybe you sell that property. It's not performing on your rental, but your equity has gone dramatically up. So maybe it's time to get out, buy another performing asset, and move on. So that's why we like to do it in this order, precisely because of that. Because first you look at the performance, and then you look at the value. Okay?
So you start with, to me, Rafi, you start with the P&L from your property manager, and now your CMA. 1, 2, and then we're going to be talking about the other 3 and 4.
So again, you have you analyze the performance, but the value is very important. And I will do the exact same thing in terms of ranking. Okay, rank which one has gone the most up from last year. Because again, you're going to do this every year. So you're going to have this, 2016, 2017, now 2018. So you're going to rank them also by which one has gained the most equity from one year to another. That may trigger some decisions again in terms of what to do, okay?
And to me, that's the fun part. That's the part of the Monopoly game that is fun. You can now sit at, like Rafi said, it's passive, so you don't do nothing for most of the year. This is the time that it becomes fun, where you move your assets around to make sure that you're maximizing your profitability.
So. Excellent. So again, we talk about performance. Now we look at value, and based on those things, you make decisions: sell, increase rents, change, do more repairs, sell or not. And then because of that, we fall into the third tip of
Before
how
we go there, we want to say hi. A couple of people say hi to us. Eric Verdejo.
Eric.
Hello, thank you for joining. Dalia, I don't know who Dalia is.
I don't know. Hey, hope you get better.
We got Maria Obredor.
Maria Obredor Selva. Maria, say hi to Aldo. Hope he gets better and he starts walking. Or you know what? Maybe not. Maybe he can. Maybe it's better for him to just stay seated. Whatever. Aldo, get better soon, man. So again, performance, value. Based on that, you make decisions. But the third one is very important. The third one is you want to evaluate your financing position. So where you are, based on that performance, based on the value, where are you in terms of your financing options? Okay, and this is one that can get very complex if we're going to do it. But bottom line, what do you want people to look at when they're thinking of financing?
Well, you want to uncover possibilities. Is it lower your interest rate if you have a mortgage? If you don't have a mortgage, uncover the possibility of pulling cash out and buying the next deal. So those are the two possibilities: either take cash out or refinance your deal, therefore helping your cap rate.
And again, here's where you look at that value analysis that you just did. And let's say that let's go by the first route, mortgage. You have some mortgage on your houses. Well, guess what? Maybe when you took that mortgage at the beginning, you took 80%, loan to value, but the property has gone up 20%. When you do the analysis today, guess what? It's 60%. Right. If you do that, you probably get a lower interest rate. You talk to your financing partner because you have a financing partner in your team. You do, right? Oh, you don't?
Uh-oh. It's kind of late.
Get it. but you should have it because if you're watching these videos, you know that a banker is part of your team. Anyways, you talk to that person and say, hey, here's where we are. What are the options? Okay, should I lower interest rate? Should I increase the loan so that I can have possibilities to buy more properties? So from the mortgage side, a lot of things to do. The cash out is one that a lot of people don't think about.
Right.
I bought it cash. Perfect. Well, guess what? Let's use an example. If you bought something for $100,000, right? And you want to buy more, and you get $80,000 out of that, and you use that to buy the exact same property, giving 20%. Now you can buy 4 properties with the same money, not putting one additional cent, with the same money you already put, and you pay your 8, 10, 12%, whatever the interest is. But this is one of his favorite metrics, your cash on cash percent is off the hook.
Absolutely. You know what's worse than a savings account at a bank?
What?
Money sitting in equity doing nothing. Especially if let's say you own a property and you have $200,000 in equity. Mm-hmm. Well, that return is doing 0. It's making you feel good at night, whatever the case might be. But that 200 could be gone if the market turns. Mm-hmm. So it's really not doing nothing for you. Put that money to work, but do it the smart way, Rafi.
Of course.
One thing that we didn't talk about is a lot of times when we buy a property, year one, we opt to get short-term financing. Therefore, a lot of times there's no principal being paid, and the loans are due pretty quick. The beauty about
high interest rate, most of
high interest rates. The beauty about now is that, and I've been investing for 20 years. The beauty is that there's so many options. There's so many investors willing to lend money at decent rates that there's no excuse for you to do some irresponsible lending.
Yes. The couple of key things that Jorge said. We are huge proponents of having stuff where principal is part of that payment. You want to lower that. Keep that loan to value no higher than 80%. We are fans of 70%, but make sure that loan to value is always below 80%. Do not, I repeat, do not go to 90, 100% loan to value. That's where people got in trouble in 2006 and 8 because they were completely off the hook. And then if you have 100% and it goes 1% down, you're already on the water.
Absolutely.
Okay, so responsible, but at the same time, it's almost irresponsible to have that 100,000 sitting there and not diversifying your portfolio.
Absolutely.
Because now, if you have 5 properties and one goes down, you still have 4. Oh, guess what?
Yeah.
4.
Yeah.
You still have 4 that are performing. But if you have just one and that one goes down, how many you have performing?
And Rafi, one thing that is a little advanced, but people don't think about this is, but I met with lawyers in the past that say to me, a property without a mortgage is an easy apple to grab.
Yep.
Because
easy target
because you don't have a mortgage. Guess what? You hit somebody in a car accident or something happened. They're gonna say, do you have any assets that are paid off? On that asset statement, you're gonna have to. And by law, you gotta say the truth. And the first thing they're gonna say, oh, let's go for the house.
Yeah.
So that's why having a mortgage also helps you, with that a little bit.
Yep, absolutely. I want to say hi to Nuria Diallo, Nikki, my friend from DC, and Danitza Santini. She's back from Puerto Rico. She was in Puerto Rico having fun over there. Thank you very much for joining. And we have a great question. We're talking about financing, and Tony Santos made a great question. Do 1031 exchanges work for investors?
Absolutely. We're doing one right now. Stephanie can tell you about the process right now. We got an investor that sold his condo because he was tired of those fees. The condo fees was like $300 or $400 a month. It was insane. He sold the condo for like $130, and he's buying 2 properties with the exchange.
Yeah.
Stephanie, how many has he bought the 2 properties, or he only gotten 1 so far?
One looking for the next property.
Yeah.
So, and he's a foreign national, so if he can do it.
I think it's one of those things, again, are you CPA?
No.
I'm a CPA.
I don't think so, Rafi.
I don't think so. So, always check with your CPA, but most of the time, absolutely. 1031 exchange, there's some rules, and you have to be very specific. You have to buy within 90 days, and there's a lot of specifics. That's why we always advise you to go to a CPA. But most of the time, man, go for it. That's why we want to make that analysis on a quarterly basis, because guess what? You needed to make that decision last year, so that then what you sold last year, now you have 90 days to buy a new one. Okay?
But by the way, we have a few articles about 1031 exchanges in homesforincome.com.
Mm-hmm.
Go to homesforincome.com, on the search bar, put 1031.
You just put 1031 in the search bar, and you find
at least 3 or 4.
There.
Yep.
Absolutely. But great question, Tony. Thank you very much. And it's something that, again, a lot of people don't know. It's part of their toolbox, and it sits there, and they don't use it, and then suddenly they go, "Hey, Uncle Sam, let me just give you away." We're not saying don't pay taxes, right? Although Jason would love to say that. We're just saying don't pay a cent more than what you have to pay. And if a 1031 exchange is a way of them making a transaction without paying additional taxes, hey, the more the better. So again, we have 3 so far. Evaluate your performance using cap rate. Evaluate the value of your portfolio using CMAs. Evaluate your financing position, sitting down with your banker to make sure that you understand the options either to refinance or to cash out. And then this one I have to say, caught me by surprise, because it's one that a lot of people do not think about at the beginning of the year to check on their portfolio. And it's the 4th tip: verify your insurance position.
Absolutely.
Every year you need to do that.
Absolutely. I mean, you got to look for the opportunity, or either, can you lower your insurance or increase your insurance, depending on how the asset did that year. It's perfect time, because we went through some hurricanes, we went through some tough weather, to say, okay, how was my property affected, and figuring out how you want those insurance to be. But, thank God we had insurance.
Yes,
right?
absolutely.
This year it was, to me, I put insurance on the top of the list.
It should be number 1.
Uh-huh.
But let me tell you something. Even it's something you have to do every year, like you said, either to lower your insurance rates, to increase your coverage. But you need to sit down with your insurance, broker, agent, and understand where you are now. Okay, because remember, you already verified the new value. Maybe with that new value, you need to increase your coverage, because now, before you were covered up to $2 million, but now your portfolio is worth $3 million. So guess what? If you have a $2 million policy, you are underinsured by $1 million. Okay? Let's use the what we've gone through with the hurricanes. If you suddenly made a major repair on your property, okay, then guess what? You may have to increase the coverage of that property, because now it's worth more. At the same time, you may lower the deductible, because guess what?
You got a new roof. You
got a new roof. You fix almost everything. So why have a $5,000 deductible?
Absolutely.
When guess what? You may have I'm sorry, the other way. You may have low deductible. You may increase it, because now you know that you most likely are not going to spend. And by the way, the deductible amount is one of the biggest factors on increasing or decreasing the premium. So maybe you say, you know what, I fixed this house. We're doing, one of our duplexes in Lakeland. We're going to fix basically from the ground up. I'm going to take the deductible the highest possible once I fix it, because the likelihood of a major expense happening now is lower, because I just completely renovated that. So those are the things that you need to sit down with your insurance agent and go, here's my new value, okay? Here is the amount of repairs that I did last year, and here are the ones that I did major repairs. Here are the ones that sometimes cities redo flood zones.
Yeah, flood zones. Yeah.
And now, before it was not in a flood zone, now it is. So you may have to change that, okay? So it's very, very important, and it's one that I bet less than 10% of the people watching this video do on an annual basis. I think they think about it when they buy the property, and then that's it.
Well, there's so many options. You could cover your rents. You could cover specific plumbing issues. I mean, there's so many options. You got to sit down with your insurance agent and confirm that what you got is what you really paid for. But not being insured for the right amount that the property needs to be insured for, it could take you back 2-3 years.
That's a killer. And sometimes for a couple of 10, $20 a month more that you pay, but you save yourself from a major headache if something happens to it. We also have Jaime Yepes that joined. Jaime, happy New Year. We need to sit down. We need to eat some arepas. Have an excuse to eat arepas. Something like that. So
it's been a long time.
It's been a while. Irina Veruska, my partner in a play. Some of you know that I'm doing some things into acting.
It's an honor to have you join us.
So
thank you for being here.
Irina, and then Victor Rodriguez also. Thank you very much for joining. So again, four things that you should be doing. And by the way,
there's more.
There's more. These are the four that you must do. There's a lot of stuff that you should do. But again, these are the four that I would say before the end of January, you should at least complete these four. Okay? The number one, verify the performance of your portfolio last year using cap rate.
Yes, sit down with your property manager with the P&L statement, where the loss is coming from, vacancy, repairs, and find ways to strategize to make more money.
Absolutely. Number two, evaluate the value of your portfolio. How?
Get a CMA, get it done the right way, guys, to make sure you have the true value of your asset.
Definitely. Then understand your financing position, okay? Where you are in terms of financing, and you have basically two options.
Two options, make sure that you have the best mortgage possible, or if you have cash in the property, pull it out to invest more.
Exactly.
Pretty much.
And the number four, what's your insurance position, where you stand?
After you build up your empire and you got your portfolio, the last thing you want is to lose a property because you were underinsured, or to find out 2-3 years later that you overpaid and your cap rate could have been a lot better. So
exactly. So those four tips, very, very important that before the end of January, you look at your portfolio, you go over those things, and make sure that you are set up for success this year. And again, if you have to make adjustments, that you make them on time and you make them the right way. That's it for today. I don't know if you have any additional questions. Stephanie over there in the comments. I think we're good. It's the beginning of the year. People are like a little bit lazy still. They're still on holiday mode, all that kind of stuff. Mario Catalino joined from Miami, Puerto Rico, but Miami. Thank you, sir, for joining. See you this weekend in La Sanse. So Jorge, where can they find us?
Rafi, they could always find us at homes4income.com. That is homes4income.com, where you invest.
We do the rest. And don't forget to subscribe to our YouTube channel. It will be in the description of the video, and also Stephanie's adding it to the comments, right now. So we're gonna start. Yeah, we're gonna start adding videos. We just added our brand new one today. You're gonna see that we're gonna start adding on a weekly basis, most likely. We're gonna try on a weekly basis. To add some of these videos to our YouTube
very close
channel.
to giving away the first $100.
I think so.
Yeah, very close.
So definitely join there. Thank you very much, Stephanie. Thanks for everything.
Welcome.
We need to order lunch, man. I'm hungry.
I'm starving,
so we're gonna do it. Don't forget, homes, the number 4, income.com. Subscribe to our YouTube channel, and we'll see you next week in our next Graystone Brown Bag session.
Bye bye.